Hello and welcome back to Investor Info. Passive income streams need an initial investment as well as a lot of cultivation. Including these streams in your portfolio can help you significantly boost your profits and improve your investment goals. After some time and effort, these income streams begin to grow and sustain themselves, providing you continuous earnings with little effort on your side. In today's video, we'll be diving into the top 5 investments of all time for passive income. Before we continue, remember to hit that subscribe button and click on the bell icon so you'll get notified every time we upload a new video. You surely don't want to miss out. So without further ado, let's get started. Number 1. First up are dividend stocks. Dividend-yielding stocks are an excellent addition to any portfolio, and investors can find many of them in almost every industry. It is one of the most straightforward methods for investors to generate passive income. As public firms create profits, a portion of those gains are returned to shareholders in the form of dividends. They can choose to keep the money or reinvest it in further shares. Yields can vary dramatically from one firm to the next, as well as from year to year. If you're not sure which dividend-paying stocks to buy, look for those that have a dividend aristocrat status, which implies the firm has at least a 25-year track record of paying out high dividends. Companies that pay dividends to shareholders do so either in cash or in the form of extra shares. If you're looking to generate passive income, these investments can provide cash on a quarterly basis, as long as the stock performs well. This translates into a steady stream of passive income or the ability to reinvest your profits in more shares. Some industries are known for having a higher concentration of dividend-paying companies than others. Real estate investment trusts led the way because their tax structure mandates them to pay out 90% of their earnings to investors in the form of non-qualified dividends, which means they must pay out investors on a recurrent basis. The IT industry is less dividend-driven, owing to the fact that many businesses are younger and prefer to reinvest profits in their operations. In addition, companies rarely announce that they pay dividends to shareholders. You might, however, check into an unofficial group of equities known as dividend aristocrats. Dividend aristocrats are S&P 500 corporations that have paid growing dividends to shareholders for at least the past 2.5 decades. This is a rather high standard to establish, implying that any of these firms will most likely continue to pay dividends in the future. Number 2. Coming up next on our list is real estate. Real estate is a popular investment option for those seeking long-term gains. Rental properties can provide apartment owners with a consistent stream of income. The investor may simply purchase a home with a 20% down payment and then find tenants to keep the money coming. One of the best aspects of real estate as a passive income investment is its ability to preserve value in the majority of economic circumstances. Real estate values are unaffected by stock market changes, and they can endure larger economic downturns. Despite the COVID-19 pandemic, property values rose somewhat on average in September of 2020. This was the greatest one-month rise since the mid-2000s real estate bubble. You may also choose real estate almost anywhere to get started. This may entail purchasing a rental home down the street or in a thriving metropolis far across the nation. Your possibilities are only limited by your budget and imagination, which means that this asset class may play any function in your portfolio that you choose. Real estate investing also provides a large level of flexibility in terms of initial financing. You can start small, perhaps with a little one-family house, or go big and acquire a multi-unit structure. This allows you to fine-tune the amount of money you want to put into the property, and it allows you to dial in the correct degree of risk for your investing goals. The more straightforward approach to get passive income quickly is to invest in rental property or real estate investment trusts. This is similar to owning a portion of a home. The amount you possess is proportional to the magnitude of your investment. A greater investment yields a higher return, resulting in more passive income for you. Furthermore, with a real estate investment trust, your investment funds can go further because the management business handles maintenance and repairs and deducts a part of your return. This means you won't have to experience the hassle of property maintenance, as you would if you invested in real estate of your own. If you don't want to manage a rental property or invest in a real estate investment trust, real estate crowdfunding is a good alternative. Investors can choose between equity and loan investments in commercial and residential buildings. Unlike real estate investment trusts, crowdfunding allows investors to take advantage of the tax benefits of direct ownership, including the depreciation deduction, without the additional responsibility of property ownership. Number 3. Third on our list is peer-to-peer lending. Peer-to-peer lending is described as the act of directly lending money to a person or a corporate entity using internet platforms where lenders and borrowers are connected. This investment category has a track record of producing strong returns for investors, with yearly returns ranging from 7 to 12%. Furthermore, after the first deposit is made, peer-to-peer lending needs little to no activity on the side of the investor. Peer-to-peer programs, on average, have lower entrance barriers than other forms of investments. Loans, for example, can be funded with as little as a $25 contribution. Rather than lending or investing in a business of your own, peer-to-peer lending businesses match investors with a variety of prospects that they then handle on their behalf. The barrier to entry for this type of investment is lower than that, say, of a private equity fund, making it interesting to qualified investors who may not want to put such a large sum of money into a single holding. However, there are several drawbacks to peer-to-peer lending. You are taking on a greater risk by participating than you would by investing in a real estate investment trust, for example. The quality of the assets may differ, and you may not be as well positioned for long-term gains as you would be with these and other options. However, if you're ready to broaden your horizons, you could benefit from exploring this passive income potential. Number 4. Next up, investment funds are a popular choice for consumers who wish to convert a portion of their assets into passive income. Investment funds, like dividend stocks, do not pay out cash to investors. This investment option eliminates the stress of purchasing stocks on your own. Instead, the funds invest in a variety of stocks or other publicly traded items on behalf of the fund's participants. You don't have to choose and monitor each of your market positions in this manner, since you're delegating that task to a manager or an algorithm. Investment funds, like dividend stocks, do not pay out cash to investors. Rather, they might include equities that are anticipated to pay a dividend to shareholders in their portfolios. For a common investor, mutual funds are the most well-known investment fund. Mutual funds are managed either passively or actively by an investment manager who has paid a portion of the fund's performance. When you invest in a mutual fund, you may adopt a hands-off approach to managing an important component of your portfolio. The fund management chooses the assets and the size of the investment. All you have to do is monitor the returns of your investment and the fund's overall performance. A disadvantage of investing in a mutual fund is that the manager fees might be high, which reduces your potential passive income. Index funds are another good choice for investing in passive income. These are mutual funds or exchange-traded funds that are connected to a certain market index. These funds, which are managed passively, try to replicate the performance of the underlying index they monitor. As a result, their underlying securities do not change unless the index's composition changes. This correlates to cheaper management expenses and lower turnover rates for investors, making them more tax-efficient vehicles than many other investments. Number 5. Last on our list for today's video will be private equity funds. A private equity fund, like a managed investment fund, combines money and invests in private, non-publicly traded firms and businesses. Private equity funds are more similar to venture capital firms in that they invest directly in businesses, mainly by acquiring private companies, but they may occasionally aim to acquire a controlling position in publicly listed companies through stock acquisitions. This investment is a wonderful way to maximize your passive income investment. Private equity outperforms other managed assets in terms of yearly return, averaging slightly under 10.5% over the last 2 decades. This might be a lucrative prospect for high net worth individuals who can invest at least $250,000 in a fund on average. While hedge funds are concerned with short-term gains, private equity funds are concerned with the long-term potential of the portfolio of firms in which they have a stake or have acquired a stake. When you venture in private equity, you are exposing your portfolio to a variety of investment options that are not available in the stock market. This includes investing in private firms, taking part in leveraged buyouts, and other possibilities with a larger potential return than most traditional investments. If you opt to invest in private equity, be prepared to pay high fees. The majority of organizations charge a 2% management fee based on assets, as well as an average of 20% of profits produced. A downside to this investment would be that it is not inherently safe, because there isn't the same level of control and regulation as with an index fund or direct stock ownership. However, you're unlikely to make nearly as much passive income with any of those alternatives as you would with private equity. And there you have it, folks. Now that we've discussed the top 5 investments of all time to add to your passive income streams, let us know in the comment section down below which one you're willing to try out first. Remember to always do your research and make the most out of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video!